The world is evolving, and you are different. Choice, it has always been ours. You can chase the trend or choose to trade with purpose. It's time to find the signal through the noise. We'll meet you at the beginning.
Good morning. Welcome to The Brew. I am your host, Lex, and we are on Tuesday's trading session. Today, we are going to talk about AI and investing, BlackRock and Aladdin, little ESG conversation. We're going to give an example of a covered call today and why those are useful. So stay tuned because the opening bell is here. What? Molly, you're back.
Good morning.
How are you?
Lex, this just in, hot off the press.
I got it right here. It's all good. It's all good. So Molly, how are you this morning?
I'm good. Well, I was thinking that in California waking up at 4 a.m. is like seeing a snow leopard. It just doesn't happen. So this is an event.
We're working on it. I know. You being on the West Coast, me being in the Midwest. I don't know, man. I know. It's no good for you guys. Too hard. By the way, did you notice that on that opening reel on that clock, it says 9 o'clock, which is Eastern time, which means 8 o'clock here where I am. It's almost perfect. Right. I wonder if the Reuven and Max and the team did that on purpose, or that was just just
you're fortuitous. Yeah, you're a time traveler technically because you're in the future for me. So we'll dive into that in another episode.
That's a good point. And by the way, the video too, I just want to make a comment. I looked at it. The guy's teeth in the first part, oh my God, he had a really weird smile. And that pit is, it wasn't a pit in Chicago. I'm assuming it was filmed in New York back in the day. But that was how it was in some of the bigger pits in the SIBO. So OEX was one of them. SPX was another. There was crazy moments like that. So that was legit. And we'll get into hand signals. One of these. Oh
yeah, we're bringing those back just to show how incredible you are. And what that took, there's a video with Robert Downey Jr. actually trying to be on the pit, and he ran out. He couldn't do it. He couldn't handle it. Yeah, and so there's only a few people on this planet who could withstand all that. So impressive.
I love it. All right, Ma, we're going to tackle a couple topics today. Two of them you're the expert on, I think.
Well, no one's the expert on them. That's the point. We're trying to learn. So we're just going to learn together. And I probably speak for the world. It's changing so quickly that once you understand it, you're out of the loop. So it's a process that we'll continue to tackle.
Let's tackle a little bit this AI and investing. Okay. So that term's been tossed around a lot lately, right? AI. I even use that Chat GPT. It's unbelievable. We'll talk about it in a second. But anyway, what do you think AI is? Do you have any idea in terms of investing? Do you have any thoughts on that? What does it mean to you, if anything, for that matter?
So AI is, for anyone who I'm sure that's the point. Everyone knows what AI is at this time. And 10 years ago, not everyone knows what AI has catapulted, and what it is. It's machine learning that mimics humans and probably may surpass us. And the stats out there are showing that it's passing the Turing test and can outdo us. In fact, we're going to touch base on Aladdin, and Aladdin, really handles the majority of analytics behind trades. So there's a lot of bots out there we'll get into this week. We'll dive into it. But I am probably naively optimistic about AI. I'm probably a rare one on that note. And
no, you probably know it better than I do, actually. I think.
Well, the consensus is we should be concerned, but I think the cat's out of the bag. The genie's out of the bag, since we're talking about genie's out of the lamp. But I think it's good.
Okay. So AI, artificial intelligence, that's what it means, right?
Yeah.
Here's the kind of crossroads, right? So you said it correctly, I think. It's about building machines that can learn like humans can, and then make, certain sort of decision tree type decisions like a human would make. And to me, it's amazing. How does this happen? Because, human being has the ability to kind of move directions based on new information. So once you task this machine to do something, it kind of has a little finite loop there. And then you got to keep programming it. So they've done this, which is amazing, I think. What I have trouble with AI and investing is it will give you a good pattern recognition, let's say, right? AI will. And then it will do something. But again, it has to be taught how to do that, right? Just like any human being has to be taught. So, am I still teaching the machine how to do that? And all of a sudden it takes it to the next level once I teach the tree to the machine. I don't know. I'm not sure about that.
Yeah. And I think the concern is algorithm biases. So it takes on the personality of the people that built it. So when it's telling you which way to go, it's coming from somewhere. So, there are a few AIs that are on the forefront, and they have different personalities. And so we'll
go ahead.
No, we'll just go over those and get to know everyone. And I hate to anthropomorphize them, but we probably should.
That was that those big words. You and those big words.
For you, Lex.
I don't know.
I
was an English major, by the way. Did you know that? Yeah, I was an English major. So yeah, I study words every day.
So my mother was an English major. She kept me on point. Yeah. Short of flashcards.
No one does English anymore. And, everyone's into finance and computer science. English is long gone.
I love California.
My daughter always says, me and mom are going to the store. I'm like, right. You were an English major. Are you serious?
Right.
Oh, that's how we say it. I'm like, whatever. All right. Sorry, I digress.
I'm going to say East Coast better. East Coast is a lot better, way ahead on that. My family's from Connecticut. Probably where I get it.
Love it.
Yeah.
So here's how I think of AI. So in my world, the trading world, let's say, I could consider a bot some part of AI. Now I know it's not fully AI. And if you go into ChatGPT and say, what do you think the stock market's going to do today? It gives you a canned response that says, we can't think like that. I don't know. That's not what I'm all about. Something to that effect. So it won't give you direction like that, right? That's where the human comes in. And that's where these bots kind of take over, in my opinion. So what I mean by that is any sort of automated flow that you as a user can push into the machine becomes interesting, right? And my the latter part of my career as a trader, a professional trader, we built an automated system. Okay. And, again, it was probably a precursor to what we consider AI now. But we did all the thinking and we programmed this bot to behave based on what our parameters were. So when we come in the morning at 8:30, again, I'm talking Central Time all the time because I'm in the Midwest, and that's when the market opens. About 5 minutes after the market opened, we would push the button. Okay. That means that the system is now searching for opportunities based on our algorithm again. And when it finds that opportunity, it fires off an order. And if it gets filled, right, the order gets filled, then there is an exit strategy appended to it. Right. But again, we built all this. It wasn't something we typed in a machine and said, hey, let's figure, you, Mr. Machine, go figure this out. It was never like that. So I guess my point is, go ahead. Sorry. Yep.
The operating system that you built has a bias towards golf, is what you're saying.
It's biased towards golf on Fridays. We never trade on Fridays.
All golf positions.
We put in the machine, no more trades after 1 p.m. Central Time.
Right.
No, but it's pretty cool, right? And it would just run. We'd sit there like this. We'd sit back in our desk and we turn it on. We go like this. This is the newspaper. We just kind of read through the newspaper. And then, we got to trade. And we look at it and go, okay, that's cool. We're losing money. Amazing. We're making money. We're losing money. Boom. So here's a point that I'd like to make about the automated part of trading, maybe some AI here too, is that the biggest weakness I've found in human beings in the investing and trading world is emotion, okay, and lack of discipline. So if you have both of those horrible traits for trading, you all of a sudden are going to handicap yourself relative to making decisions. So where these bots come in and these AI learning tools come in is it takes that emotion out of the equation, right? Super important. And it adds a massive dose of discipline to this decision tree part of it, right? Think about it.
I love that.
Yeah, but you've got to stay by it. So what I find some of the retail traders asking about today relative to this topic is and they're not using the term AI. They're using more automation or bots or things like that, right? So we're kind of lumping it all together a little bit. But they're like, hey, do you have the ability to exit a trade? I said, why do you want that? And their first answer is typically, hey, the reason I want that is because I can't sit in front of my computer all the time. And I'm a doctor and I got to go meet patients. And, while I'm meeting patients, I'm not tending to the flock here of my trades. I said, that's a great answer. Because these people, I was mistaken. I thought everyone just sits in front of the computer for 6.5 hours a day, but not in today's retail world. It's very touch and go. Yep.
You bring up a really great point. That Trade Hawk, I think the program that you built that you're talking about really helps people evolve. Trading's evolving and they can integrate that with their daily life and be on the go and start to maybe even trade stocks when they're in a room. So they're grabbing a Starbucks and they love it and they drink it every day. Can they buy into it as well?
Right.
With your app from your iPad or wherever you are.
Yeah, no, it's great. That's the part I love about the modern day of trading with relative to this. So, I don't know. I'm not sure where the AI goes relative to the actual trading part of it. I think what it's going to be useful for is I said earlier, pattern recognition a little bit. So can it read candles on a chart and recognize patterns that, it sees, and it says, wait a minute, every time this pattern pops up, the stock does this. Well, once I know that, or at least I think I know it, then I can make a decision on what I should do when that happens. I get long, I get short, I do something else. So that kind of information is at my fingertips. Now all of a sudden I can respond to that, 1,000 times. So that's the beauty of the automation piece.
And BlackRock's Aladdin handles 21.6 trillion in assets. So there's data and analytics from Aladdin driving. Aladdin's watching us right now, and BlackRock is driving this technology. And there's a concept in AI where the first contact was curation. So there was a race for your attention. Second contact would be creation. So now it can create trades and it can create its own thing. And personally, I think maybe the third contact would be no contact. So will it slide in? And how many people know that Aladdin's one of the largest,
So is like Aladdin
guys on the field?
Is Aladdin Alexa's daddy or mama? I mean,
yes,
that little Alexa thing.
Right.
It's like an Aladdin, right?
You're gonna love this, but the AI behind that Amazon's built that is available on AWS is called Lex. So we're curious here in the world. Yeah, are you AI? How do we know? Lex?
I'm just this bot, right? No, they give me better hair. They give me better hair if I were a bot.
You know so much, and your options brew on Thursdays is so technical. Makes me wonder. I just wonder.
I don't know. I wish that
if you're human.
Yeah. So tell me, more about BlackRock and Aladdin. This kind of leads into the next topic, I think, right? So BlackRock owns Aladdin. Is it a subsidiary of?
Yeah.
Okay.
BlackRock's run by Larry Fink, and Larry Fink developed Aladdin, and he basically, BlackRock is often considered the fourth branch of the government. So it's important to know that they're out there, and they advise on the 2008 crisis. They were responsible for advising a lot of bond purchases, as well as this last coronavirus COVID crisis. They were also asked to advise on that. So they've advised the government to jump into ETFs. So we should all know about them. And if you don't find, after you study them, make sure that you don't trust what we say. Go out there and do your research, and just keep them in the back of your mind, along with Aladdin. And that's who they are.
Okay.
And so
sorry, go ahead.
No, go ahead.
No, I was going to ask you if would you purchase BlackRock, the stock? Is that something you have in your would have in your portfolio? And again, not investment advice.
Right.
Right. So is that something you would have or not? Because I don't, and I don't pay attention to BlackRock very much. But I know they're gigantic. You said 21 trillion, right?
That's Aladdin. So assets under management is about 9 trillion for BlackRock. So they're advisors, but their system, their AI tech program that they have, actually that behemoth of data analytics, the 21 trillion just flows through their hands, but their assets under management are about half that.
It seems really a lot.
It's a lot.
Trillion. That's a big number, right?
That's a huge number. And if you compare million to billion to trillion, our minds almost can't fathom it.
Right.
So this goes back to that philosophical question you were talking about, which was, how does AI drive trades? And so do you trade, BlackRock's going to go up. They're just, their hands are across everything. They're so diversified because I think their average ownership on almost every S&P 500 stock is about 5%. If you were to go to Yahoo Finance and you go to holders, you'll see on any company you're investing who those top institutional investors are, and they're always up there. So they're always going to be. You can't go wrong with investing them. And philosophically, do you want to invest in them? So that's where your own personal preferences come in.
So they're so gigantic. Yeah, they have a good seat at probably every board table that they invest in, right? At 5%.
I'm sure.
My God, that's huge.
Yeah, they have a lot of voting
Berkshire
rights.
Hathaway of sorts, right? So
yes.
I mean, even way bigger.
So,
God, that's
Berkshire Hathaway, State Street, Vanguard, and BlackRock are, if you were to put Berkshire Hathaway aside, they call them the big three. So Magnificent Seven, you'd have, some of the FANG stocks, but this is the big three. And I think they own a quarter of equities. It's a big deal. So it's good to know about them. And, it's a good hedge to see what their moves are and how they influence other companies. It's good. It's a good edge.
I love it. I love it. Hey, guess what? The markets are open.
Ooh.
So here's what we're doing. Let me go there real quick. So Dow Jones, it's up $130. No, I take that back. It's up 130, 0.38%. Nasdaq's down 44, about 0.31%, and the S&Ps are up 2.5, measly 0.06%. Not much. Looking at the board still. Yeah, Kyle, VIX. We'll talk about VIX in another show as well. We'll dive into VIX. That's 13.53, the spot price of VIX. So that's kind of the headline number that everyone looks at. But there's some intricacies to VIX that we should discuss down the road. And we'll just refer to VIX as that cash number, right? It has no meaning whatsoever to pricing options. But nevertheless, it's the number that everyone looks at.
And Lex, this is where your magic comes in. So much. So for those that don't, that might sound like Greek to a lot of people. Have patience and walk every one of us through it, and you let us know what does that mean? What is the VIX?
Yep.
What is the Russell?
So all these are indices, right? And every one of these indices has different combinations. And we talked a little bit about this yesterday. Most people, the average folks out there who are watching the market, they tend to focus on the Dow Jones. It's 30 industrial stocks, right? And they rotate over time, the ones that become more important. The NASDAQ has, I think the NASDAQ is 100, but I could be wrong about that. I think the QQQs are 100. The problem with the NASDAQ is it's very heavily weighted with Apple and Tesla in it. And those things tend to move that index based on what those two products are doing because they're so massively capitalized. Yeah, techie kind of stocks. That's absolutely NASDAQ. Okay. And the S&P 500, as the name implies, 500 stocks, a better kind of dispersion of stocks, in that basket. 500 of them, at 500, there's typically there's no one that could overcome it. So that's why I like to look at the S&P 500. And interestingly, we call it, the traders in the Chicagoland floors calls the S&P 500 the SPOOs, SPU apostrophe S, SPOOs.
Oh, we're bringing these back. These are amazing.
Yeah, the SPOOs. And the reason we call it the SPOOs is the S&P, the first two letters, is the call letter of the product. And then the last letter is the future symbol. So the U symbol is that September? I think it's the SEP future. Or it could be the June future. Geez, I forgot already. See, I'm getting old. But every futures month has a corresponding letter. And the main one was the U, which represented that month. So December, January, February, March. March is a main one. And then 3 more is June. Every quarter is the main future. So for whatever reason, the U future, I think it was September, became the call letter. Everyone calls it the SPOOs in the industry. So what are the SPOOs doing? It's not, what are the S&Ps doing? What are the SPOOs doing?
So we're definitely going to have to make a cocktail called the SPOOs, right? I like that. Have to figure out what's in that cocktail. There's
got to be a little
like next to the covered colada. Next to the covered colada.
I love it. All right, let's move into this covered call because I want to use my little tool. Tell everyone about this little tool that I have.
Remarkable. If you're hearing us, we love your product. Remarkable is for all of us who miss paper, and I'm sorry, trees. We'll find a solution for you in the future, but for now, I think this is the solution. So there's going to be, it feels like paper when you draw on it. It's
the best. I love this little thing.
It's the best. It's amazing. Right. Yeah.
Okay. But so here's my little, what's that?
This is where all of your experience, I don't think people realize who we're in the room with. So this is a fairly simple position. So you're bringing it back for the rest of us. And I think people are really going to enjoy this.
This is cool. So, okay, just first of all, excuse my drawing because the lines aren't very sharp, but let's talk about the axis. So this y-axis is what? So that's P&L, right? That's a horrible, look at my handwriting. Jeez. This is stock price. I do a lot of abbreviations too, right? Okay, so I just marked this spot. This is a covered call, first of all. And let's pretend we love BlackRock, and we'll just say BLK covered call. Is that the symbol for BlackRock?
BLK, yeah. That's
okay,
perfect.
BLK covered call. So why would we use a covered call in the first place? What's the point of it? Well, number one, okay, we own a position. So we have inventory, right, in a stock. Okay? And it could be any stock, Amazon, you name it. And you, as an investor, are a believer in this stock. You own it. You want to keep it. You believe it's going higher. And it's something you just have in your portfolio, right? We all have that to some degree.
Right.
So when you put a covered call on top of it, what you're saying is, hey, I want to generate income to help enhance my portfolio, you know, in this case, BlackRock or whatever stock you own. So you're going to sell a call, okay, on the stock that you're long. Okay.
And I have one question, Lex. Would this be similar? Maybe this is too reductive, but would it be, if the stock were the house you owned, would a call be charging someone rent? So there's a little bit of income off the appreciation. Yeah,
that's a good analogy. Yeah, something like that. I love that. Yep. So charging a little rent, you're renting the coach house in the backyard.
Okay.
Very popular in California. Been there, seen all those. What do they call those? They call them like AD something or others. I forget. But I've stayed in one before. So yeah, it's kind of like, renting a little income on your property. I love it.
Right.
Okay. So you sell this call. Now, what call do you sell? So there's only, 20 different expirations. There's only a million different strikes. This becomes a little bit more of a, what do you feel about your stock, right? So the closer to at the money is the strike closest to the current stock price, okay? The closer you get to that, the less space you have here because it's already at the money. And this difference here, okay, is the premium that you sold that call for. So if you sold a call for $5, at expiration time, this is your profit, is the $5. Now, this point where it crosses the break-even line, is the strike price of the call you sold plus that short premium you sold it for, right? So if you have a 50 strike call, I'm just making this up, right? Let's say this is 50, which I know it isn't in BlackRock. If it's a 50 strike and you sold it for $5, again, making that up. So this point would be what? The 50 plus the $5, or 55 is where it's going to break even at expiration. Does that make sense?
Absolutely.
You can say absolutely no, it doesn't make sense, and I'll go over it again.
No, I think you're doing like, I think this is such a great explanation. And you know, the great thing about these live shows, you can actually pause, rewind, and study these, you know, and go back to them. So this is perfect. This is perfect.
So yeah. So now you've got to decide, where do I go? So if the stock's trading 50 in this example, do I pick strikes up here? Do I pick the 55 strike? Do I pick the 60 strike? I don't have an answer for you for that. I don't know the answer to that, because it's a thing that, you know, you have to have some knowledge or basis on, you know, what you believe about the stock. Most people who do this covered call strategy believe that the stock is a great investment. It's going to go higher, but it's not volatilely going to go higher. Like, it's not going to just like scream higher like GME did that one time, right? So it's just, these are stocks that grow over time, and it's a great way to push out premium. And we call this sale of the call premium. So I'll use that term a lot, and I'll speak like a trader most of the time. So Molly, you gotta say, hey, what the heck does that mean when I say things? Because just assume everyone knows what that means. Yep.
Okay.
Go ahead.
And it's a question. So if you're using a covered call and it skyrockets, what are some of the difficulties
Good
you'll
question.
confront?
Yeah. So don't forget. Oh, and I should have said this. Number 3. This is a 1-to-1 ratio. What does that mean? If I own 100 shares of BlackRock in this example, I would sell one call. Options are on 100 shares of the underlying. It's automatic. That's how they're made. So if I have one call, that's right. One option contract is controlling or not controlling, whether you're long or short it, 100 shares. And there are many special cases to that. We'll nail that way down the road what the special cases are. So if I have 100 shares, I have to sell one call, right? And what one special consideration is that if this stock goes up and it goes through your strike price, okay? So now that your strike that you sold is in the money and it comes to expiration, you're going to get assigned. And when you get assigned on your short call, you are getting short stock. So you have long stock in your inventory. Your option is selling 100 shares at expiration. If it's in the money, they net out to zero. You have no position anymore. Okay, so you're out of the position. So you have to consider that as an investor / trader where you sell these things. My feeling is that most people who use this strategy don't really want to be called on the stock, right? So what they'll do, and we're going to stop here after this point, and we'll pick it up next time. What they really want to do is they want to roll their short options. So they typically do these in short dated terms so that the decay is great. And as it comes to expiration, they will buy in their short call in the front month, and then we call it rolling. That's my rolling symbol. Roll it to another month. So let's say month 2. I'm just making that up. It doesn't have to be month 2. It can be anywhere. But they'll just keep rolling this thing. And if the stock goes up, they might buy in their 50 call and sell out a 60 call in the next month because the stock has gone up. So they've taken the risk of exercise and assignment off the table and pushed it out in time when they do this roll. Very common in the industry.
Okay.
All right? Makes sense?
Makes sense. And, you know, there's a lot of terminology that might be new to a lot of people. So we'll put those all in the show notes underneath. And this is a learning adventure. So we're going to cover covered calls. I'm here all night, folks. All week.
All week. We're gonna look at this again. But one last thing before we go. And guess what? We didn't get to ESG. We're going to tackle that next time. This covered call strategy, I've used the short call and long stock, right? It is a synthetic short put, okay? And we'll talk about why. So the short put graph looks exactly like this, okay? We're going to go through synthetics in one other show. That's a lot of drawing on the screen. I love this little pad, by the way. And I'm very messy. I can see it on the screen. God, look at my handwriting. It's horrible. Anyway, so we're going to go over what these synthetics are. It's important to understand these. Now, in today's retail world, you can't trade synthetics for any sort of arbitrage edge. It just doesn't exist. You don't have fast enough machines, and you can't click fast enough. But we're going to talk about the relationship of this covered call to the synthetic put or the actual put. Okay. Because they are they're not mirrored. They're the same images of each other. Isn't that just wonderful? Who gets up at 8 o'clock in the morning and goes through this heavy stuff? This is insanity.
Well, I know your rolling icon looked like my hair about 5 minutes ago. I feel like that was exactly what I looked like. I think that was a picture of me.
My hair always looks like my rolling icon. That's why I picked it. So getting a haircut tomorrow though, Mal. So it's all good.
All right. Nice.
All right.
So ESG, that's gonna be a fun topic. I think that's gonna be really fun topic.
It'll be good. We'll talk about that tomorrow, maybe if we're feeling up to it. I mean, I see how these things are going. I get going and I can't stop, and all of a sudden I got 2 topics and blah.
I know.
You got to shut me up.
We're gonna have I know we're gonna need 3 hours on this every morning. People will get tired of us. All right.
Well,
and then you have
all good. Yep. Good.
And you have a summit coming up, which is exciting.
Shoot, I forgot about that. Yeah.
So,
and Brian, to the summit. That's tomorrow at 10:30 Eastern, and I'm your host tomorrow on that. And my panel is going to be on AI and investment. We've got 5 great technology type people and people in partners of Tradier. So there we'll be on the panel, and we're going to deep dive into AI and what it all means for investing. These guys are really good. So way better than I am at it, and they're going to tell you all about it.
All right. So, thanks for today, Lex.
You're welcome. That's the closing bell. I love hitting that little thing. See you tomorrow, Mal.
All right. Bye, Lex.
All right.
The world is evolving, and you are a different choice. It has always been ours. You can chase the trend or choose to trade with purpose. It's time to find the signal through the noise. We'll meet you at the beginning.
Bobby, you didn't look nearly as much like a gangster in the picture they're using for that one, so I think that's good.
I've been told I look more like a gangster in that picture. I don't know
You
I don't
think
know what
so?
I'm supposed to do.
I don't know. Yeah, you look like a gangster no matter what. I think there's people actually watching now, so let's start the podcast. Welcome to the Trader's Edge podcast. I'm Jim Urio, brains behind the operation, executive producer, co-host Bob Iacino. This is going to be really fun, in my opinion. This is a new show that we're launching. It's going to be geared more toward the trading community. What we like to do, generally speaking, is Bobby and I kind of describe our trading style as 60 to 70% technical, 30 to 40% fundamental. And we love to really break down the macro and then bring it down to its effect on certain asset classes. Today is a great day to talk about stuff because there is a hell of a lot going on. Bobby, what do you think are the main things we should be addressing today?
Well, I think we should be looking at kind of an order of importance, and I should say a reverse order of importance. I mean, we had the BOJ on Friday actually adjust their policy. I don't even know how to word that because they didn't really make that big of a change, but it's also that big of a change, for them to actually do something. They haven't really done anything in this direction. I mean, you could say in a couple of decades, really. And they haven't had inflation in a couple of decades, and now they finally do, and it's going to affect the markets. And one of the things I want to tell the people watching is we're going to try and get you guys to understand the why of what's going on so you could focus on the what in terms of what you have to do to actually get better at your trading, get more profitable, manage those losses, manage that risk better. We're going to talk a lot about managing risk because risk is cheap right now. But in terms of what's going on, I think we have to talk about what the Bank of Japan did.
Okay, well, that tacitly saying that the downgrade by Fitch is nothing to you, or no?
No, because this is in reverse order for me. I'm going to go from the least important thing that matters. But the key part is that it does matter, right? It matters a lot.
Right, the Bank of Japan thing. You and I talked about this offline yesterday. This is going to fuel a trade that I'm going to put on from the Bank of Japan. Because here's what the implications as I see them are. You can fill in if I'm getting something wrong. So the Bank of Japan that hasn't seen inflation in 40 years, whatever, let's say 50 years, doesn't matter. All of a sudden inflation is starting to show itself. And they've had this yield curve control where they've had zero yields basically throughout their whole yield curve. And it was change in the 10-year, not zero, but don't hold me to that. But anyway, if they're going to all of a sudden let their 10 yields go higher, that means our 10-year yields are going to go higher. That, in my opinion, at the same time, the disruption of the market could kind of move our Federal Reserve into being a little less hawkish and a little more dovish, which might depress front-end yields. And I think the curve is going to go back towards zero. And I know a lot of you guys who are watching this trade stocks and gold and oil, and we're going to talk about that stuff too. And I know rates is getting in a little bit of the weeds, but I think this is interesting stuff today. You like that trade? You don't like that trade?
No, I do like that trade. Look, here's why I think this is important for equity traders as well. What you're looking at here is, now we all talk about how many treasuries China holds. Japan is the king. And Japan has been for a long time in terms of U.S. treasuries. And part of what drove money out of Japan and out of actually a lot of the countries in Asia into the U.S. was the rate differential. We all talk about the carry trade, right? Where you borrow from a country in their currency that has low rates, and then you invest in a country that has higher rates, i.e. the U.S. And all you do is hedge your currency risk and you let that money sort of accumulate. These kinds of moves leads to soft unwindings of that carry trade. So what's involved with those unwinding? It's selling treasuries, which is exactly what we're seeing with the higher yields we've seen. I'm not saying that this caused it. I'm not saying that the Fitch downgrade caused it. I'm saying we're seeing little things that are causing a shift in the yield curve, which is part of the reason you want to put on that trade, where the yield curve is actually going to go back to its rightful shape a little bit quicker than maybe people thought. That's why I like that trade.
Well, so what's irritating is that all day I've been real busy today with client stuff, so I didn't put on the trade. And I know I'm going to come in. I'm going to log into my screen tonight, and it'll be already running in my direction, which is going to irritate me. But I'm going to do this well. You mentioned currency risk, and it should be important to remember that when you're borrowing in yen, you have a lot of currency risk. Right? I mean, and when you're long yen to buy, whatever. So you get what I mean. The yen has been pummeled through these things. So I think it's really interesting. And again, I will add that this kind of Thursday night, Friday morning, there was just a whisper of it that came from the Bank of Japan. And the market doesn't really think it's a huge deal yet. You agree with that, correct?
Yeah, and actually, I'm gonna put up a chart. If we could put up this JGB chart here, this kind of illustrates what you just said, that the market doesn't think it's that big of a deal yet. This is the Japanese 10-year or the JGB yield. Okay, so you can see on the left corner of the chart here, I'm actually going to see if I can annotate this chart. Jimmy, you're going to have to tell me if I'm actually doing it. Can you see my cursor right now, Jimmy?
Well, first you have to tell me what annotate means. I'm a math guy. I don't know your fancy English.
Yeah, I don't really know what it means. I made the word up, and I'm hoping it means what I want it to mean, which basically means mark up the chart. But now I've decided I don't even know how to do that. So let's try this little thing here. Is that writing? It is.
Yeah.
Okay, so this little circle I just drew is basically the aftermath of the BOJ's decision, right, which happened on Friday. Here's Friday, right? Actually, this is Monday. So it happened on Friday, Sunday night, Friday morning, whatever you want to call it, Friday night, Sunday morning. And this is the first effect of it, right? Basically, right here where I'm going to put my crosshair is the old level that they were holding rates below, 50 basis points, right about where my crosshair is right there. Okay, so right about where I drew that rough line. That's 50 basis points. That was the old cap. So that meant that the Bank of Japan at 50 basis points was going to buy the hell out of the JGB to keep rates there or push them lower, which they did all in this area of the chart, right? They were able to keep it below that level. Even in here where people tried to spike it, investors and traders tried to spike it above, the Bank of Japan smacked them, right? And pushed it back down there, and they lost money on that trade. Now they're allowing it to do it, but you see that the market is barely testing it. We have rates that went from 50 basis points to 62. All right, so that's from half a percent to about 0.6%. Yeah. And the Bank of Japan hasn't done anything yet. Now they have said that they're going to at least let rates float to about 1%, and they wouldn't let it go past there. And the market's not taking it to 1%. That tells you how little of a deal it is. So this is one of those things where it's a big deal, but it also, market's afraid to test it.
Okay, so when we say traders, when you made that circle, I prefer we call them evil speculators. I think that's what they're called. So the evil speculators try to test it. So now for people who are watching, the machinations of them doing yield curve
I don't
control,
think that's a word, but go ahead.
Machinations is a word, I swear to God.
It's machinations, but go ahead.
Is it really? But anyway, so they have to buy bonds to keep rates at the yields they want. What do they buy them with? Yen. Where do they get the yen? They create the yen. That's why the yen has absolutely imploded over the last couple of years. I believe it's down about 25% against the euro. Against the dollar. Right. Is that correct? Yeah, that's right. So that's if people who don't trade bonds, don't trade currencies, that's an interesting little side note of this is that the currency market is showing you that they're probably getting toward the end of their ability to do this. You think that's a fair assessment?
I do. And I drew this big blue arrow mostly because I was trying to figure out how the arrows worked. But also it kind of goes from that 50 basis points breakout where the Bank of Japan actually pushed it lower to where it is now where the Bank of Japan is not pushing it lower. So anyone who thinks that this wasn't really, that the Bank of Japan wasn't serious about it, the market is testing levels right now. Right. So how's this going to affect markets? Right? Well, it's going to affect markets because at some point, the Bank of Japan is going to either let it go further than evil speculators thought it would, or they're going to smack them back down. And that's going to cause a bunch of sort of dominoes to fall. And actually, that's one of the things I want to talk to. We got Steph Pomboy on our podcast next week. Not this one, but our Futures Edge podcast. And this is one of the things I want to talk to her about.
No, that's good. And again, this is important. I don't recommend trades, but I will tell you what I'm looking at and what I may do. And the steepening trade, what do you call it? You call it a steepening trade, even though it's going back to zero. And technically, the curve is inversely steep, but I want it to go back to zero. So I will probably be doing that by buying the micro CME 10-year and selling the 2-year. That's what I would do. The CME and again, I don't want this to be a commercial for anybody, but I do use their products and I like them. But they just came out with a product that you can trade them both in tandem. Did you know that?
I did. Yeah.
Yeah, you can trade the 2s versus 10s. Okay, let's move on to the Fitch downgrade, which I think is partially comical, partially interesting. I'd like to get your thoughts on it first.
So first of all, this is another situation where it's a big deal, but it's not, right? So Fitch just downgraded the U.S. from AAA to AA+. That's where Moody's and S&P has had the U.S. since about 2011.
I thought it was just S&Ps. Moody's too has them.
Well, Moody's did it. Well, actually, here I could put something else up. I don't know if this is going to work. Hang on a second. Okay, guys, we're going to have a little bit. No, I'm going to have to actually show this. So let me show one more thing here, and I can switch back and forth then. So I'm going to put up one more thing. Let's see, share screen. I didn't anticipate sharing this, but this will help answer your question. So this is Wikipedia, and I'm not sure if I should trust it or not. Can you see it?
Nope.
Tell me when you can see it. Those guys got to put it up.
Also, welcome to our first show here.
Right.
So it might be a little bit of growing pains. Okay, what do we got?
All right, so if I justify this by rating, right? So here's all the AAAs, and this is Fitch, right? Here's S&P. Now you notice down here the US is AA+, right? Standard & Poor's, if I click on that, the US is AA+. Let's see where Moody's has us. Moody's, let me go back to rating here. No, you're right. We're still stable at
still AAA. Yeah.
Right. So anyway, back to the point. The point being that the big deal is if the other rating agencies follow. So if all of a sudden Moody's downgrades us to the same level that Fitch does, if then S&P decides, well, now they're AA instead of AA+, that causes forced treasury selling. And again, we're going deep in the woods on rates. I get it. We'll get to equities. I'll get to some individuals. Jim will get to the S&P. But what you're talking about there is forced selling of treasuries, which causes forced higher rates.
Because pensions can't hold things that aren't AAA rated in some
not just pensions, but several institutions have mandates where they say you can only invest in AAA. And a lot of that just defaults to treasuries, especially recently, now that treasuries actually yield something. Some of the underfunding of pensions has been because treasuries have had no yield. And now all of a sudden we get into a situation where treasuries have yield and these pensions can actually start to catch up again. And now we get downgraded and they may not be able to. If there's pensions out there that use Fitch, they have to sell.
So tell me this, do our new partners on this podcast mind if I use the expression bullshit or no?
No.
Okay, good.
We're right ahead. It's fine.
Because this is an absolutely bullshit thing that's happening, and I will say why, and I'm curious if you agree with me. Okay, the reason these rating agencies exist is to be a buffer, to be an analytical buffer between an uninformed public and the potential bond that they may be investing in. The notion that Fitch, S&Ps, or Moody's can add anything to the analytics of U.S. government treasuries, which are the most traded, the most analyzed, the most overanalyzed asset on the planet, is comical. And to do this out of the blue, and again, we are running up massive, massive deficits. And this is weakening the currency. But anyway, to downgrade our bonds, it means that there's risk holding the bonds that you're not going to get paid. That's stupid again, except, you are going to get paid. They have a printing press. You might get paid in a garbage currency if they keep printing money and damage the U.S. dollar. Let me go here. He's on a roll.
Keep going.
So the point I'm saying is that this is really just a downgrade of the U.S. of the currency, of the dollar and dollar policies, right?
That's exactly what it is.
Unless you're saying that the machination of paying is fine, but the politicization could potentially come into conflict again with actually paying out bonds. So that's a genuine risk if two political parties can't get along and they decide to shut down bond payments, a technical default that could morph into an actual default. But the reality of it is, this is not like downgrading a tier 2 auto manufacturer who might not be paying its bonds and maybe close to bankruptcy. It's kind of bullshit, yes?
I had a drink down here in Southwest Florida with a guy who's been on our other podcast, very well-known guy. I'm not going to say who it was. And he maintains that any analyst, not just a Fitch, Moody's, or S&P, but any analyst, and this is to people watching now who might trade ETFs or might do call flies or call spreads off of a stock, off of an analyst upgrade. Okay. Long term, those things mean precisely nothing, because this particular person has been in the room, and I've been in one of those meetings, but he's been in multiple meetings where they basically said, look, we can't downgrade them to sell because they're a client. He said basically all holds are sells. That's what he said. Okay. Now, I can't say who it is, and I'm not going to say who it is. I'll tell you in private, Jimmy. You know him very well. And it's one of those things where when you look at this kind of a downgrade in terms of what the value of a U.S. Treasury is to an institution, tell me what's better. I mean, I'm looking at that list of other AA countries. Let's put this up again. The list of other AA countries, right? Now, this is per Wikipedia. So you, as a pension fund, you think you're better off being in the bonds of, I don't know, pick one of the AAAs. Luxembourg?
Yeah,
maybe.
No.
I mean, you're better off being, by the way, Singapore has about 136% debt to GDP ratio. It's somewhere in that range. Sweden, you want to buy Swedish bonds? Okay, fine. You got currency risk in those. You think that you're not going to get paid? You're worse off trying to risk getting your money from the U.S. than you are from the Netherlands? I mean, first of all, if the U.S. can't pay, neither can any of those.
No, anyone else. Now, I will put a finer point on that. Like, we're debating whether or not this is a bullshit rating. We don't have to debate it because I can prove this unequivocally. Why, you ask?
Why?
Back in 2011, when S&P did the first downgrade in my lifetime, the markets were a little bit disjointed. Stocks broke a little bit too. What happened then? All of a sudden the flow started to go in to U.S. Treasuries as the safety trade. So the very thing that was downgraded ended up through a small chain of events was the thing that was being bought to protect yourself from that thing being downgraded. Okay, so now I don't think that quite happened today, but yesterday and today, you saw the dollar, the U.S. dollar, which I just made the argument that it was the thing that's being downgraded because you're going to get paid back. What happened? The dollar rallied.
Yeah, the dollar is still up today, by the way. So I don't know, Jimmy, you kind of froze there, so I'm going to keep talking. But the dollar is up today. Okay, so you now have 5 consecutive sessions of a higher dollar in aggregate. You have 11 of the last 13 sessions. This is what Jimmy was referring to when he said the exact thing that was being downgraded, which is de facto the US dollar when the Treasury's bonds are getting downgraded, was what people rushed into to protect themselves. So a question for you. Is there still, though, is that part of why the markets are dropping today, given that regardless of whether we think this is bullshit or not, it still means that money costs more?
Right. It does mean the money costs more, but there's something more important to it as well. I think we've been on somewhat of a one-way street for a long time. Market positioning gets to a spot. Bobby just talked about volatility being so incredibly low, options being cheap, protection being cheap. We spent weeks with the VIX under 14. People were getting bulled up and too much on one side of the ship. So is this an effect? Yeah, if money costs more, it's definitely going to have an effect. But more importantly, people are just like, is this a real risk? Maybe, maybe not. Do I have too many stocks on? Yeah, probably. So it's time to sell. And that's one of the reasons we use technical analysis. And we are breaking through what I think is a fairly major technical spot. And if we settle, and we're going to talk about stocks a little bit more, but if the S&Ps can settle solidly below 45.50, which they were trading at 45.37 the last time I saw. This is the S&P futures. We're in the SEP contract. If they close below there today, I believe that's a significant signal. That's probably the 5 to 8% correction is afoot. And it's not necessarily because of the fundamental story. It's the fundamental story coupled with market position, which creates the need for a correction. Make sense?
Yeah, it does. We got a question coming in on this, Jimmy, but just real quick to update everybody. The September S&P futures are 45.3650. The SPX, that's the Dow Jones S&P index, 45.1367 as we speak. So the question for funds needing to hold AAA rated assets, can they hold an asset that is rated AA plus by 2 agencies and AAA by only one agency. Now, I know the actual answer to that. I think you do too. You want to take it?
No, I want you to take it because I don't know it for sure.
Within the institutional world, you have disclosure documents, and those documents, even with pension funds, describe exactly what you are allowed to hold. So it will say in your documents, if that's a possibility, it will say that. Okay, otherwise it will say as listed by Fitch or as listed by Moody's. Oftentimes they say as listed by two of the three agencies, which is part of the reason this is a bigger deal than people may think. Because it often, some of the documents I've seen over the years when I was at my fund of funds especially, they said as listed by two of the three major rating agencies. Just like when you would ask for an audit, it'd say audited by one of the big five. It gives you that option. So there are definitely institutions out there that say as long as one of the three agencies has a AAA rating, you could buy them, but it's very specific in the documents.
Bobby, though, is it not? I was under the impression that once the second domino falls, the third domino is usually relatively quick to follow. There's no benefit in being the one holdout. It's better to be all three of them to be all wrong together than be the one that's wrong. So my guess is soon that will that S&P or Moody's, whatever, will change its rating as well.
And there's something we have to look at with this before we move on is how much of it. So there's been a lot made of it by pundits, of which I guess you and I used to be and somewhat still are, that this announcement came right before the next Trump indictment. Now, we're going to try and avoid politics like the plague in here, but there is some talk, some chatter that the sort of stability of the political system here is part of the reason that Fitch caved.
They said it, though. Didn't they?
Yeah, they said it in their statement, right? They said that there's some political instability. I don't know if they were as specific as, for example, CNN said they were, but I don't. So anyway, moving on.
No, but to your point though, that's not, I mean, if Fitch is downgrading U.S. debt, which is what we trade, which is what we think is basically the dog and everything else is the tail, if they're telling us that it's because of political instability, then political instability needs to be spoken about by financial analysts. It's not political to talk about it. It's policy, right?
That's a fair thing to say, yeah.
Good. Yeah. We hate both sides equally. Just now, that's not true. We hate both sides is true. But
hey, one last thing on the Fitch thing, because when you said we hate both sides equally, it reminded me that we both kind of hate the Fed. And one of the things these agencies do is there's so much opinion. You know, part of, again, that guy that we both know that said, I've been in meetings when they said we can't go to sell because they're a client. When you have people involved, things kind of become bullshit the way you mentioned it. Similar to the Fed, deciding when inflation is transitory, then deciding when it's not, then deciding that they need to aggressively, destroy the regional banking system, and then deciding when they need to aggressively pull back and deciding when they need to switch. If there were actual mechanisms in place, for example, if the ratings agencies, at least with government debt, said when your GDP gets to here, you lose a rating point.
Your debt to GDP.
Debt to GDP, sorry.
Right.
Yeah, when your debt, and there would have to be more than that, obviously, but if they actually put mechanisms in place that were transparent and understandable for the average person, nobody would have any questions.
Yeah, and as the Fed should be doing that too. The Fed should be managed by a computer, except for the fact that some of the data points they use to measure inflation, I question and challenge. So those would have to be revamped as well. But I agree with you 100%. The Fed is doing a great job in cleaning up the mess that they completely caused in conjunction with the government, which, by the way, we bring up the Fed. That leads us into now speaking about some of the asset classes that we want to talk about on this show. Should we start with stocks?
No, let's actually start with crude oil because that's going to take me to a couple of energy stocks.
Oh, good. Let's do that. I'm just grabbing a water out of the fridge because I got a little bit of coffee. So keep going. Yeah.
Crude oil is in a very interesting place. We actually talked with Mike Arnold, who we will have on this show, is my business partner, and he's also just a cherished technical analyst that Jimmy and I talk to all the time.
Outstanding. Yeah.
He is outstanding. I mean, and I actually mentioned it to the guys we're doing this show with, that he just simply has to be on. We talked about crude oil with him yesterday, and he talked about how crude oil had kind of made a breakout that then was sort of waiting on a pullback that holds. Okay. We're getting that over the last couple of days. Now, forget the reasons why we're getting it. This is why I said what I said in the beginning of the show, is that for a lot of times people are like, well, why is this happening? Right. And you end up kind of screwing up your active investments, wondering why something is happening. If you haven't reached your risk point and you haven't reached your take profit or your sell covered calls or whatever else that you do in your particular strategy, when you focus too much on why, you really screw up your process and your plan. But so one of the things that both Jimmy and I do, and we did this before we knew each other, so we didn't get it from each other, is we like breakouts, retests, and holds. And you're getting that retest right now. It's not here yet, but the couple of days lower that we've had in crude oil, especially today, might be the time to start looking not only to get into crude oil futures contracts if you have a futures account, but energy names, like some of the downstream energy names that people look at. You might want to be looking at calls and call spreads and even the outright stocks, because some of these things going into, people start to look at those and they say, okay, well, we're going to come out of the summer driving season and that's not going to be so advantageous. And seasonality is a mother effer, right? I mean, it's a big deal. But if you have the thick of hurricane season coming, right? Supply being withheld by OPEC, exploration, okay, U.S. exploration, looking for more oil. They ramped up funding to the highest level since 2019, yet the finds, okay, the discoveries of actual deposits of crude oil are 42% lower than this time last year. So we have reasons to think that there might be supply issues. Now, we also have a globally slowing economy, arguably, right? Not everybody agrees with that, but you could have a real supply crunch right as we get into the meat of hurricane season.
Tell them the good part, Mortimer. The most fun part you're missing.
What's that?
Is that if it starts to run to the upside, there is a very real possibility that OPEC might even welcome that, for the notion that the U.S. might have to refill the SPR, which they've extremely depleted.
Oh, the SPR.
Again, the SPR.
The SPR.
Right. Yeah. So the Strategic
Stupid
Petroleum Reserve.
asses.
Right. If we ran it down to the tune of about 60%, there is a time we're going to have to refill it. They don't want to look stupid. Spoiler alert, they're going to look stupid. And if it starts to run, them trying to refill the SPR is going to exacerbate the move.
And this is also at a point in time where Saudi Arabia is very softly moving away from the U.S. Right? They're moving away from what they consider to be their reliance on the United States militarily, politically, from a currency standpoint. They're actually open now to doing business in other currencies. By the way, those of you who think the dollar's going away as a reserve currency, none of us who are old enough to watch this will see that. It could happen, but none of us are old enough to see that.
But by the way, I will add about the Saudis, like what we did to them. Remember, they sell oil. We intentionally, and for no apparent reason that I can find other than possibly election, depressed the price of oil. We went out, and why would they be happy with us right now? I think it was really kind of a stab in the back to them. You agree with that, right?
Yeah, I mean, all we talk about as a country is getting away from their product.
Yeah, they can't be happy with that.
Yeah,
right?
So why would they drift away from us? You know, when the Saudis talk about moving away from fossil fuels and becoming a more green economy, that's very similar to me, you know, to when, I don't know if I should make an Anheuser-Busch joke. Go ahead, we'll move on.
Okay, no, I don't want to move on from oil yet. Can you pop up?
No, I don't want to move on from oil, but I want to talk about.
Good, yeah.
I don't want to make an Anheuser-Busch joke.
I do, but we'll do it later. Yeah.
All right, let me put up a crude oil chart. Getting one ready, and then I got to share it. Welcome to our first show where I'm absolutely not prepared for what I need to do here. I think I'm actually moving pretty quick.
I do too. And again, it's a first show. If you guys don't expect growing pains, you're watching the wrong show. We are not perfect by any means.
All right, here we go. If you guys can put that up as soon as you get it. This is a daily crude oil chart. So this is what I mean about the pullback. Whoop, hold on. I got to reconnect this session. By the way, I'm in the midst of California. I'm in the midst of a Florida storm, which could take my power out at any moment, just so you guys know. It usually
good. Then I get to talk and nobody interrupts me. It's like
so
a
usually
dream come
comes
true
back,
to me. Yeah.
It usually comes back. Yeah, you love the sound of your own voice. It usually comes back really quickly, but the internet takes a while to come back. So this is something we talked about, Jimmy. So you can see my cursor here, right? I think I'm going to avoid the pen for now. So I have had this chart drawn in, or I'm sorry, this channel drawn in since about August of last year. Now it's a rough channel, right? I wasn't trading this channel. But what I've always told people, and for those of you guys that don't know who I am, I spent about 5 years, actually more like 6 years, at a boutique oil firm in Chicago where we actually moved barges of oil. Now I came up in the futures market, so I always knew about crude oil. But I became kind of known as sort of a crude oil expert simply because I worked at that oil company and I learned things that as future traders, you just don't learn. For example, how fast crude oil goes through a pipe and that they can't make it go any faster because it damages the viscosity of the oil, things like that. So once I started learning those things, I started trading crude oil a lot more. So I've been trading crude oil as my main futures product. Okay. And one of the things I'm very fond of saying, Jimmy, is you probably shouldn't look at energy companies if you have an opinion in crude oil, because you know it's 100% correlated to crude oil.
Crude oil.
Crude oil. But
Right.
if you don't have a futures account, some of the downstream names and some of the bigger names usually end up working. They correlate pretty good short to medium term with crude oil, not long term, but short to medium term. They do correlate pretty good. So anyway, this is the channel we've been looking at. Now notice that this channel, this downsloping channel, this is what crude oil does. It operates in sort of a congestive way when supply and demand is basically balanced. Okay, now this was obviously with a little bit of a lean toward more supply, less demand, but still a congestive channel. You wouldn't really call this a trend. If you want to see a crude oil trend, here's a crude oil trend, right? Here's another one over here. This is right here is the invasion of Ukraine by Russia. Okay. These are trends. This is not really a trend. Okay. It's just kind of a sideways, slightly moving down type
gentle sloping, right?
Yeah, gentle sloping channel. So we broke out of this channel and I don't really care about that. What I care about is that we broke out right around the 200-day moving average. Okay. And now we're pulling back, and anywhere in this area here, I will use the pen for this. Anywhere in this area here, to me, is a retest. Okay. So if we come down and we don't go back into the channel, okay, that's going to be a pretty significant sign. Now we've got to get above this defining point here.
Part of the circle is back in the channel though, but it's just the top.
Yeah, I'm just highlighting it. I don't want us to close back in the channel.
Got it.
All right. Now, if we close back in the channel, spend a couple days there, and then pop back above it and break this high, then that's still a hold to me. Okay, so all of these are areas, right? So this is why, like, people say, why didn't you buy the breakout of the channel? Because I don't know if that breakout is just going to cause me to redraw the channel. So look, this is what this would look like. Let me get rid of this. If this breakout failed and we got all the way back deep into the channel and there was no way we were breaking back out again, I'd be redrawing the channel looking for the same kind of a situation. Let me see if I can figure out how to do this right now.
No, and that looks like a perfectly legit channel as well.
Yeah, it will if I can figure out how to. Oh, I'm still in the pen. That's what it is. All right, hold on a second. Let me get out of the pen here and get back to my cursor. All right. Now I can do it. So if we broke out, if we went back into the channel, I would just be redrawing this channel to look something like this.
Yeah.
Okay. And then I would say, okay, we're back in the channel. And the channel's just got flatter, and crude oil is still operating the same way that it normally operates, which is going within a channel. Sometimes it shifts the channel in one direction. Sometimes it shifts it in the other. So based off of this, if any of this retest, if I go back to the old channel, if any of this retest holds, that was pretty slick how I did that fast, right?
That was cool. Yeah, that was cool.
Very, very cool. If this holds and we start to go back up again, you want to look at crude oil, you want to look at USO, and you want to look at crude oil names, okay, energy names. And that will trump.
What names in particular?
Well, I have always liked Chevron for this. I've always liked Chevron as a stock to trade. I don't like sort of the shale names, okay, like not a Devon Energy, they don't really apply, but look at some of the shale companies. I don't like that because of the particular time where this exploration has been bad, right? They've been spending more money and not finding deposits. Okay, so that's why I say you want to look at more of the diversified companies. I love Occidental Petroleum for this. I can actually change this on the fly to Occidental Petroleum. Sure. That's one of my favorites simply because I don't follow Warren Buffett, but when Warren Buffett buys something, you know he bought it long term, okay? So that means that this particular underperformance here doesn't bother me at all, right? Yeah. This is a really good example of another retest because it's testing this area right here. You can see this. I will talk about these particular moving averages one of these days. We don't really have time to do it today, but it's going into what we call the rotation zone, which is formed by these two moving averages. And we've got the 200-day right here, which is flat, so it's less significant. The 200 is much more significant when it has a slope to it, like here. But when it's flat, it's less significant. But if you can pop back above this high and above the 200 in here, that will coincide with crude oil holding and breaking back out. So Occidental will be a really good one. I'd have a target of Occidental Petroleum somewhere around $70 at that point.
Nice. A last question about the oil names, and then you want to move on to something else. A lot of the big integrateds pay a sizable dividend. When rates are high, does that make them naturally less attractive than they normally would be and could depress price?
Say that again, because I was looking at something.
A lot of the big oil integrated names are big dividend payers, and they trade like dividends. And also rates are high, so that's kind of a headwind to these oil stocks, right? Or does that not even matter?
No, it matters. It does. But I've always said when you're looking at something like an oil company, like Occidental has a good dividend yield. Chevron has a great one. Exxon underperforms, but has a phenomenal dividend yield. That should matter, but that falls more under the category of, to me, of financial advice. So it matters as to what you're doing. If you're looking for like the biggest return on your buck, and I talked about this in one of our podcasts. I'm not going to swear as much as we normally do. I don't give a crap, a damn, a shit. I don't give a shit about outperformance to the upside. I don't care if you made 10% and I made 7%. I don't care about that. What I care about is protecting capital because that's how you last. Right. And that's what matters, protecting capital. So if you're somebody who's in a position where it's like, look, you have a $50,000 account with Tradier or something like that, but if you lose that $50,000, you're in a lot of trouble, then go to a slower performer like an Exxon, for example, and take the dividend and don't worry about it.
Right. By the way, when I was mentioning dividends, I wasn't talking about collecting dividends. I was talking about stocks that may move faster compared to rate moves because of the dividend.
Yeah, and let me answer that correctly because you also compared it to rate moves. The whole thing of TINA, there is no alternative. People say it went away when the 10 years started yielding 3.5% to 4%. If that were the case, stocks wouldn't be up as much as they are this year. I think that's complete bullshit.
Okay. So you want to talk about stocks and I'll let you let into that?
Yeah, we got another question about crude oil. Okay. So let's answer that. They're going to put it up on the screen for us. What do you guys think about Saudi Arabia's latest push to move away from oil by proposing the line, the giant linear glass city in the desert? You want it?
No. Because I don't know the answer to that. I like to pretend I know the answers to everything, but you know oil better.
Okay, so I'm not going to speak from a cultural standpoint, okay, because I don't know Saudi Arabian culture. So there's going to be a little bit of American/Italian cynicism here. That test city reminds me, and that's what it is, Jimmy. It's a test city, right?
I read a little bit about it, yeah. Right.
It's kind of a test case of a sort of zero, maybe zeros pushing it, but a zero carbon emission city. China built a lot of apartment buildings and condo buildings that ended up being, there's a great documentary called The Ghost Cities of China or something to that effect. I think that's what's going to end up happening here. If you sell Italian beef in Chicago, you don't test sushi. You just don't. Right? Jimmy has a restaurant in the suburbs of Chicago called Branson Palatine, open Saturday through Sunday. I don't remember the hours. But they do burgers. They do unbelievable burgers and some of the best tater tots I ever had in my life. When I went there to eat, I didn't ask if they did sashimi or, do you have a ponzu yellow white tuna I can eat it?
No.
I don't take it seriously at this point. Now, if there's a cultural reason for doing it, I don't know. I could be completely wrong. I don't know what that is if that's the case.
Yeah. And I don't mean to, I'm not going to go live in any of your, bullshit glass cities, zero carbon cities. I'm not ready to do that yet unless I'm doing it at gunpoint. So I don't think it's going to be a successful endeavor personally. But yeah, it's a good point. Yeah.
Yeah. So let's move on. Yeah, let's move on.
Okay, let's talk about stocks and let's talk about, first of all, I'm, again, like I said before, I believe a technical pullback is probably in the cards depending on today's close. What do you got now? Do you see it up on your screen right now?
The market. Yeah, give me a second here. Sorry. This is something I will also get better at. Down 1.51%. We're at 45.3175 in the futures. SPX 45.0948.
Okay, so here's the reason I've been trading this from the short side, and I've had a good day of trading today, which, by the way, the downside of having a good day trading is you think you're a genius. And for those of you who know me and listen to my stuff, I don't need any more reason to be a blowhard who thinks I'm a genius. But anyway, today I had this down move, and the reason I traced it back, we talked about it yesterday on the show we taped, is that back on Thursday of last week, we had that higher high, lower low, closed on the beat low. From a technical standpoint, after the run-up that we had over the last few months, I believe that would be an opportunity for people to take some chips off the table if it settled below the low that we made on Thursday. Today, we are going to do that. I now believe that a correction is in the cards, and I am actually positioned for that. Again, we talked about the fact that options were so cheap, and Bobby said still so cheap. They're not as cheap today. The VIX shot up pretty high today. I think it's close to about 16 from 13.5. But when you get opportunities to put on protection, you take them. Now might not be the best opportunity. Can we put up the 6-month chart? And then we can, now that it looks like we're getting the close I want, we can talk about where our objectives are on the downside.
Chart is in the window. Hold on a second. Let me put it up. All right, there's your S&P chart. I can restrict it to 6 months if you want, but basically this is 2023 right here.
Okay, so do you think that those highs from, where is that, the high from a couple months back? We'll keep going to the left. I know, the highs from, like, is that out of the reach? What is that level? Again, my old man eyes can't see those levels.
You're about 42. You're about 42.06, 07. Again, this is a continuous futures chart for everybody that's wondering.
So
we could do this down the road. I'm sorry, Jimmy. Down the road, everybody. If you want to see SPY or SPX, let me know. I can put those up. But we're just going to go with futures because of the continuous chart. Let us know if that doesn't work here. So I'm going to drag this blue line there, Jimmy, just so you can clearly see it right here. And that, let's call it 4,200 for lack of a better.
So if we call 46 and change the top and 4,200 here, we're talking about basically a 10% correction down to that level, right?
Yep.
Bobby, for the folks at home, how many times is there an average of 10% correction per year?
Twice to 2 to 4 times a year.
2 to 4 days, right. So an average, and have we had one this year? We have had one this year. Is that one? Yeah, that looks like one from before. But to me, that seems very reasonable that we trade down to that. Now, I have what I had put on, and I've been talking about this for a whole week. I'm not just talking about it on the down day. It looks like it's triggering. What I did to prepare for this is I sold a put that was basically 5% out of the market to buy 3 puts that were 8 to 9% out of the market. So it's a 1-by-3 put spread that I sold the 1 leg, bought the 3 leg. So my theory and thinking was that as we start to go, and it's working pretty well today, that not only will vol pick up, which will help the 3 out of the money puts, but also skew, meaning the further out the skew smile, the further out those puts are, the more people may panic and jump into those. You said these people are a new audience. You give your opinion on that trade, will you?
Yeah, so I really like the trade because I see a number of reasons. Like oftentimes, I'm going to put a line here too, because this particular peak, believe it or not, is not as strong a support level as you might think it is. And the reason I say that is because it's basically only been tested once in this chart. If I tighten the chart up, even in these areas here, it kind of got blown through a couple of times. You might call this a test. But anyway, back to the trade. The reason I like this so much is because I'm going to throw out a couple of stats, and these are stats from work that I've done with my partner, Mike Arnold. Going back to the yield curve, I know we did a lot of talking about interest rates, and you guys might find that boring, but we're going to convince you as to why it's important. The yield curve has been inverted to historically negative levels for a historic period of time. It's too low for too long, okay? When the yield curve inverts, it's a sign of an inflation. There's only been one time the yield curve has been wrong, okay? This could be number two. It could.
Sign of a recession is what he meant to say.
What did I say?
Inflation. Don't worry, I speak, Bob.
Yeah.
I'll keep him.
Inflation makes my money recess. That didn't make sense. All right, so yeah, it's been the sign of a recession. There's only one time it's been wrong. What are the odds that the deepest and longest inversion is not going to cause a recession? I say that's pretty low. So what happens to stocks? Okay, stocks do not bottom when there's an inverted yield curve until after the yield curve has gone back to its normal shape. They bottom after that, 10 times out of 10, the last 10 times this has happened. So this particular move that I'm highlighting here with my cursor, okay, this move here does not take a recession out of the picture. Stocks have to perform while the inverted yield curve is going back to its normal shape. If they do that, if the stocks don't turn negative, once it's already, and by the way, the bottom in equities doesn't come until after the inversion is finished and we've steepened already.
Okay, can I tell them?
We're nowhere near.
Can I tell them why that happens though?
Go ahead.
Which actually, Bobby helped coach me through this about a month ago. So when the yield curve starts to head back to zero, it will mean a couple things. It will probably mean, if history is any guide to this, that the Fed will have overshot, got to a point where burning timbers are falling from the ceiling, and they rush in to depress short-term rates, their tool. So when they depress short-term rates, that's the main thing that's going to be steepening out the yield curve. I get confused because it's technically steep inverted, so it's going back to zero, which is technically flattening. But again, it's semantics. That'll be the thing that steepens the yield curve out. It means they're depressing short end rates. And that will be at the same time that there's a panic in stocks. It's usually a panic in stocks that accompanies whatever the dominoes are falling that freaks the Fed out. Did I describe it properly?
Yes. Okay. And that brings me to the next point. It has to be, it doesn't have to be, but it's more likely that stocks will fall and then bottom if the yield curve is steepening in a bearish way. Now, what do I mean by that? The yield curve can go back to its normal shape with rates rising or with rates falling. Right now, it's doing it with rates rising. That's not good. That's not what we want. We want it with rates falling. So why do we want it that? Well, we want the stocks to actually bottom versus their historical factors that cause them to bottom, so that not only can we trade from the long side, which everybody's got to admit, trading from the long side is more fun, right? Because monkeys can do it, and I tend to trade like a monkey. So trading from the long side is fun, and if we get that inversion to go back with interest rates falling, you're going to have a dramatic decline in stocks, and 10% could do it, by the way. But it can be the true bottom. We don't have to break the October lows for this all to play out correctly. So when people are talking about, I hope a recession doesn't come, I hope it doesn't either, because I don't want people to be out of a job, right? And we do have to have employment get a lot worse. But I do want stocks to bottom so I can buy more of them for the longer term. Right. So don't be afraid of recessions in terms of from an investing standpoint. Okay. From a home standpoint, I get it. From a losing your job, I get a different thing. So it's not out of the realm of possibility to fall 10% at all. That was a long way of saying that.
No, that's fine. Totally. Again, I need time to nap too. So when you want to go on your long rants, just give me a clue like this. Sorry, hey, guys, we've been doing this a long time. Yeah. We will give each other a hard time. And I hope you're
Do you mind if we talk a little bit about the payrolls number that's coming up?
Not at all. I think we should.
Because I'm going to put a couple things up now, and this is going to take me a minute as well. Actually, I don't even know if I'm going to be able to do this. I'm not. So I'll save this while I can't say this.
I'm going to say one last thing about stocks while you're trying to get it up too, is that I need to settle below 45.50. I'm reiterating this again. We popped a little bit, and my screen right here says right now 45.38, and we got 9 minutes left in the day. If we settle right on it, the market has a way of confusing the shit out of the issue and making it less clear. If that's the case, then I want to see some downside tomorrow before I increase any of those shorts.
So what I wanted to point out was that we have some labor force growth going on. And I'm still trying to figure out if I'm able to share this while I'm talking to you guys. But we have some labor force. I can't do it. I'm going to work on it for next week, guys. But we have some labor force growth. We have labor force growing by about 60 basis points a year for the last 5 years. Okay.
Hold on. What does that mean? Labor force growing by 60
the size of the workforce.
Right? Oh, it's growing by 0.6%. Right. Okay.
Yeah, it's been growing by 0.6% for about 5 years. And when you do the math, considering that the labor force about 167,000 5 years ago, it's been growing by about 81,000 jobs a year. People.
167 million.
Yeah, there you go, 167 million. So it's been growing by about 81,000 a month over the last 5 years. So 81,000 is the baseline of jobs. Now, what I wanted to put up was the last few months of job numbers. Other than these individual spikes, it's been a downtrend in terms of the monthly figures, okay? So if you were that kind of person and said, well, let me take out these outliers, you would have a solid downtrend. And we're approaching that 81,000 level. When we hit that level where 81,000 jobs were added, all you did was take care of the workforce population growth. That might be a better way to say it. And you have not added new jobs. Okay, that'll be your first sign. So when we get down to, if we get down to 150,000 jobs, 120,000 jobs, you guys keep in your thoughts how close you're getting to that 81 to 85,000 new people entering the workforce level. And that means that a spike in the unemployment rate is likely coming. And the Fed wants to see that. And as soon as they see that, start looking for Fed speak that says, we might need to cut rates, or paraphrases, we might need to cut rates. I think we might be sub 200,000 this particular Friday.
Okay, and I will add to that when you take out that nonsensical birth-death model, which is terrible at turns, and for you people who don't know what the birth-death model is, it has nothing to do with actual births and death. It's about companies being created, new businesses, and it's a backward-looking average that they add into the number. Meaning if the market's turned and all of a sudden the economic conditions have grown more negative, that they are looking at the wrong window. So the birth-death model is adding a lot of jobs to the headline number, as is government jobs. If you took them out last time, that number would have been a lot more ugly than the headline looked. And so I am believing, and again, if anyone wants to know what my opinion is of the coming recession, that Substack that you put out, was that this morning or was that yesterday morning these days?
Yesterday morning, yeah.
I wrote it and Bobby published it. You can go to his Twitter page. And I believe that the delay of the recession is due not to the as much to the rapidity of the rate hikes as it is to how low rates were for the 5 years that ended with the first hike, meaning that all the consumers and small businesses who needed duration, locked in duration. So a lot of those people just sitting on the sideline going, geez, I'm glad I don't need to borrow money at these high rates. And I think that's delaying the recession. But I think when it comes hard. You agree?
I do agree. And I really wish we were doing the show yesterday, because you and I yesterday talked about puts and selling calls and why those were a good thing to do right now. We talked about the relationship between options and your portfolio and how options is sort of like insurance. Well, actually, that's the original purpose of options, right? Is insurance. It's like car insurance, where you bet every month with your insurance company that you'll get into a car accident, and they bet with you that you won't, and you lose that bet every single month or every 6 months, right? You'll lose the options as insurance bet most months, right? You'll lose it. Jimmy was talking about how it's costing him money to buy some of these puts and to do some of these trades. that were insurance for what might be a downturn. And these are the reasons you do it. If we're right that this let me rephrase that. We're not wrong that this downtrend can extend. We're just not saying it will. We're saying it has the possibility of extending, especially when you look at things like the downgrade potential and other things that are going on with crude oil and the Bank of Japan and other things we talked about. So when you're looking at that from a perspective of that, when insurance is cheap, you should think about taking a little bit of your profits and buying some of it, or taking some profits in the form of covered call spreads, whatever.
Right. And I'll add too, the options position I had on, the selling one, buying the three that's 8 to 9% out of the market. I don't need the market to go below those levels to take a lot of profit on that. I'm not looking necessarily for them to be in the money. I'm looking for the pop and vol and the pop and skew, and then I will take them off or roll them into something that's more attractive to me. So that's why even if it breaks down, like if we lose 5% and you're like, oh, it's right in the middle of your your top to bottom of your spread, I don't care about that because I will still make money on that, right?
Right. So those are the structures. So, you
want to call it, or you want to do one more asset?
No, we're running out of time, so I want to call it. But what I do want to do is, this is going to be a weekly thing. So if you guys have questions that you want to make sure we get to, reach out to Tradier, get them to us ahead of time. That'll always help. But you're always welcome to put questions in the middle of the show. Tell people about the show. We're going to be here for a long time. We're not going anywhere. So.
And it's going to look different as we move on. We're going to bring in some guests. And one thing that's cool about Bobby and I being in media for the last 20 years, meaning trading for 20 years, for 40 years, is that we've made some cool relationships along the way. So there will be some amazing guests. I do want a bunch of input from you guys who are watching it too. I look back at this show, I wish we would have gotten to a few more assets to chart them out at least, but I want to know what you guys think as well, because we want to tailor this for you. Is that it? How do we sign up? Do we have we'll get some symbols or bang a gong or something that means the show's over?
I think our guys will take care of that.
Shows are always so hard to end. It's like a phone call with your girlfriend. Like, no, you hang up. No, you hang up. So
guys, I think you should just cut us off. Just whenever you want, cut us off and put up the outs. Put up the outro.
Thank you, guys. Yes, here we go.